Hey, what's up, everybody? This is Matthew Mickey, and I'm going to continue on with my session on the bonds and why every type of trader and investor should be aware of this information. Because even if you trade bonds or not, or fixed income, like you need to know this stuff to understand the health of the economy, and that way you know what sector you should be trading in versus what sector you should be fleeing away from. Now, we know that this is what a typical yield looks like. You have the shorter time on the left going to the right, longer time, and then the interest rates going from the bottom up, right? And now we know that the action by the Fed is physical policy, and the bond market snitches on them to tell the public when the Fed sees growth slowing down. You see, one thing that 42 Macro Darius Dale taught us through his studies is define causation before the effect through raw data, right? And if you wait to hear it from the news, neighbors, friends, and family, it's too late. You're already too late. So how do we listen to the tattletale bond market? Like, remember the videos I did on the yield curve explaining the basics, right? That's how. The spread between, let's say, the 5-year and the 30-year shows us where the Fed sees the projected risk that they are borrowing from to pay back 30 years from now. Are they focused on risk 30 years from now and growth 30 years from now, or are they freaking out and trying to sell the 1 to 2, the 5-year bonds, right? Well, if the shorter term treasuries are being auctioned off at higher interest rates, the more likely the Fed sees something in the near-term future that will jeopardize the two mandates, price stability, which is inflation, or employment, which is growth. And all traders should pay attention to the yield, not CNBC. So if the 5-year interest rate is increasing and the 30-year interest rate is decreasing or flat, remember what I said about getting paid for holding and managing risk. You can see economic growth or slowdown happening just by paying attention to this, right? So the spread on the 5-year yield tends to focus on the short-term monetary policies like the taxation and budget sheet and the cycle that we're currently in, right? And it will tell us if the Fed are going to do quantitative easing or tightening within the next 5 years. On average, quantitative tightening and easing lasts 5 years, right? The 30-year shows us what Ray Dalio said calls the big cycle and who holds the world order. And we can see, based on the 30-year yield, what kind of potential growth and possibilities are being funded by the Fed right now. Like, government money, is it going towards education, demographics, structure, productivity of the country, technology, improvements? Where is the Fed focusing on? The now or the future? Think of your household budget. Are your funds being allocated to the now only, or to the now and the future? Do you have enough funds to survive now so you can save for college, houses, or emergencies, paying debt off? Or are you making minimum payments, living paycheck to paycheck, while accumulating more and more debt? The Fed works the same way. So the short term has higher interest. If the short term interest rates are higher, then you have to you're more than likely focused on the now and current events, and you're borrowing while your long-term growth and productivity in your lifestyle remain stuck or decrease. You're just going down a cycle of doom, right? So the same thing goes with the bond market. It tells us the government's monetary policies and budget, if it's too tight or not, and just like your budget does. So now let's talk what we can see in the inverted yield curve and what it tells us as equity traders, as option traders, futures, crypto traders. It shows us the amount of liquidity that is currently in the market, and how volatile the market's going to be just off of this one chart, right? Not because people are lending like crazy and purchasing treasuries from the government, but because higher interest rates on short-term bonds shows us there's a lack of demand from banks, meaning less credit's being loaned out, meaning the Fed Reserve has to raise interest rates on those to coach them into lending them money. This usually indicates a weaker consumer and corporations, and with the weaker consumers, companies' evaluations slow down due to that weaker consumer. The companies lay off employees due to tightening their own budget sheet, etc., etc., etc. While this slowdown is happening, earnings and evaluations start to decrease. Companies are increasing liabilities, their own debt. So where do increased valuations and earnings going to come from if there's a lack of real revenue due to the Federal Reserve hiking interest rates? Right? So now let's talk about if the Fed tightens too fast during the slowdowns in growth, then it brings up nasty real rates, which is the nominal yield and inflation expectations, which will impact evaluations and earnings, and the stock market returns will decrease, hitting the companies even harder, forcing them to increase the price of goods and services, meaning inflation, because now the consumer's dollar doesn't go as far as it's supposed to. Now, remember, the real interest rates are the difference between yields, right? It's the nominal yields and inflation expectations, and I'm making videos on that and all that. So hopefully this helps. Pay attention to this because it is a clear indicator on what's happening in the now, and is our country going to be blooming and growing in the future, or are we just living paycheck to paycheck? Learn how to check these on your brokers, and learn where you're going to pull the data from. There's going to be future videos on how money is created and like how this all ties together. All right, guys, later.